Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth online. As always, it's zinniawealth.com. That's ZINNIA wealth.com. And if it's time to talk about your retirement, that is why we're here, to introduce you to Charisse. Maybe you don't have that person that you're talking to yet. Maybe you are asking your friends, well, who did you use? And how can I get in touch with them? Well, this is a show where we show you what's going on out there, how Charisse is helping people navigate through it. And if you would like to give us a call, it's 833-368-3680 for a no-cost, no-obligation look at your retirement. Just sit down and say, here are my questions. I'm wondering about this. Did I get this handled? Is my advisor doing the right thing? And then maybe sometimes you find out that they're not, that there's more to do. That's why we have this show. Charisse, how are you doing today?
I'm doing pretty good.
Pretty good. What happened?
I have a bum ankle.
Uh-oh. From?
No. Pickleball. So the kids and I, yes, we decided to say, let's get committed to pickleball.
Uh-huh.
And we did our first lesson, and Ella is naturally just really great at everything she does. And she's played it a couple times with her friends. So she was good. She's trying to school me the whole time. Mm-hmm. And Eli, it was really one of his first times playing. So, it took him a day to get that figured out. By day 3, they were both just hitting it really hard, consistently. Even my son, I was so surprised. I was like, wow, he's really picked this up quickly. Mm-hmm. And they decided on day 3 that both of them want to play against me. Mm-hmm. So I knew I'd be running all across the court. So I won. I just want you all to know I won. And I twisted my ankle winning.
Okay. It's so shocking to me that your children are competitive. Where did this come from? I don't know.
Can I tell you, if you were at the court, we were so loud and we all got so competitive. I'm going to tell you, this is the second time I've seen my children like crazy competitive besides Monopoly a month ago or so. And it was so much fun because I just love seeing them want to beat their mom and just really get good. And it was just so fun. It reminds me of a conversation that I had with Tim Tebow, and he says, oh yeah, my mom, my dad, my sister, we were out there playing volleyball and we were smashing this other family. We had to win. And like, that was that's how they did their thing when they'd go on trips together. I'm like, oh, it sounds like my kids now that they're older. So it was a lot of fun, but I have a hurt ankle, so I'm taking a week off.
All right, good. We're chaining you to the desk. There will be no mountain climbing this week, okay?
None.
All right.
No, but it was fun.
Well, speaking of climbing mountains, some people look at retirement that way, and it is kind of a big mountain because, there's a lot to know out there and there's a lot to be concerned about. And people are looking at the market right now, Charisse, and they're wondering, is this real? Because I mean, you see Intel and they're up like 200%. And I found another one, Micron. It took them 37 years to get a market value of $100 billion. It took them 3 days to get to $200 billion. Come on, man. I mean, that just can't be real. I mean, I am a little worried about all of this, that the shoe is going to drop, something's going to happen, and down she goes. But anyway, I'm reading an article about all this, and it said that you should approach this market with 1 foot on the gas and 1 foot on the brake. Yeah, I get how. How do you do that? So that's got to be one of your big challenges, is finding that balance in a market like this. How do you do it?
So it kind of reminds us of the 2000 to 2002 tech crash, right? Just, we are all tech heavy. It just plummeted. And this could be the artificial intelligence crash, right? And we don't know. But where's all the value and real return in it all, which we're not seeing? So the math doesn't make sense. And I always say, past performance is not indicative of future results. So times could be changing, but the growth has been fantastic. I was just doing a review with a client, and they've been with me for 10 years. I remember the first 5 years, it was kind of, we're trying to see where's our growth. And because it was up, down, up, down. And the last 5 years been nothing but skyrocketed up. They were like, Charisse, our returns are just off the charts with you for the last 5 years. And how long can this last? I'm like, you know what? We're going to keep going while we can. But that's why we have the safe money strategies built in. And they always know what their safe money strategies are because there's quite a few of them built in. And then they also have this other bucket, which is this growth. So we want to take advantage and put the metal to the pedal when markets are good. But we also want to make sure as you're prepping for retirement and or in retirement, that there is a game plan for what if we have a tech bubble crash like we did for 33 months as the stock market's going down in 2000 all the way to 2002. And not all of our money has to make 15 to 25%. Some of our money can make 4 and 5 and 6 and 7 and 8, right? That's your safe money strategies. If we're averaging, 4 to 6% in a retiree's portfolio over the next 10 years, that's what we should be looking for. But the averages have been so much higher that times are changing a little bit, right? And people are taking more risk, Randy. When people come in and we do a portfolio x-ray and a second opinion review, I am seeing an absolute highest level of risk than I've ever seen in time. And I've seen a lot of these stock docs out there that people are working with and advisors that they're putting them in more tech heavy, right? Because tech heavy is hey, that's what's working right now. But there's no plan for the income if the stock market were to go down. And one of my reviews that recently came in said, okay, Charisse, I have $3 million with you and 1 million is totally safe. We've averaged about 6% in it. And the other one is a moderate portfolio and the other one's a super risky portfolio. Okay. He's like, I want to make sure we're in line with my income needs because they need a very high number when it comes to income to cover the gap that Social Security doesn't cover because they love traveling and they're still super young. And I said, well, that's part of our conversation today. So what we're doing is we're implementing a second version of phase 2 of the retirement plan, which we do when the timing just makes sense. And it depends how long you've been with us and how much growth we've had, where now we're going to take some dollars and really just put it in the other piece of the Zinnia puzzle, right? So we have something called the Zinnia 5. And we don't ever talk about it on radio. It's kind of our thing when you come in. But it's part of building your retirement by design. That's the basic strategy. And building a retirement plan by design does not mean your portfolio will stay the same. Our clients' portfolios change on an average of every 5 years. Somebody who's been with me 20 years, they will tell you that to be a true statement. And we want to adapt to the changes. We want to sprinkle in other growth strategies and other safe strategies. A safe strategy is not a CD. Right? It's not a money market. It's not all your money in annuities, right? It's not all your money in bonds. You have to have a mixed strategy. And as things are coming, you have to have an advisor that's not afraid to use other investments to help your portfolio average out a higher average. Because if you have a 60-40 portfolio right now, it's doing all right. I'm going to tell you, it's probably doing great right now. But it wasn't doing great 2 years ago, and it wasn't doing great a year ago. And when interest rates shift gears, it's going to go back to not doing great again because interest rates change how you make money in your bonds. And the advisors are not changing your strategy. They're just set it and forget it. And you think they're managing your money and they're making all these trades. You're like, Charisse, I see it rebalance. I'm like, yeah, by law, we have to rebalance. It's an auto button. Nobody touches it. It just happens automatically. So people think that's active trading, yet when the interest rates go up and their bond values go down, then they're asking, well, why did I not make as much money? Right. And that is the reason. It's an autopilot game. And we don't do autopilot here. And we're always shifting gears as gears are being shifted because I don't want to be going backwards all the time. And so we got to be able to shift between all the gears when the timing is right.
Well, you think about it, if you were to look at the last 20 years, last 25, 26 years, and look at all the stuff that has happened in 25 years, a retirement is probably about 25, 30 years, right? So who's to say that from today, for the next 25 years, we're not going to see the same kind of stuff? Now, I don't know we're going to go through another 2008, but maybe there's something else out there. We've had plenty of things that are affecting the market. To have an advisor that is moving with all of that and changing strategies as interest rates change, as the economy changes. I mean, look at what AI has just kind of come up and just taken over. We didn't know that 5 years ago. Well, we don't know what's going to happen 5 years from now. Let's have a plan for it, and an adjustable plan for it at that. Here's the number to sit down with Charisse and get a no-cost, no-obligation look at where you are right now. If you have an advisor right now, that's okay. Come on, bring it in, and she'll give you an evaluation of it. If you don't have an advisor right now and you're just getting going on retirement planning, let's start from scratch. It's no cost, no obligation to get going. 833-368-3680, 833-368-3680, or online, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that, and you'll be on your way. All right, so if you look at how retirement has changed over the last couple of years, there's been a significant change. We've all talked about the age of the pension and how that's kind of gone away. Well, when pensions were king, people retired at about 62. They got their Social Security, they triggered their pension, they had their savings, bing, 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 three-legged stool, we're on our way, easy, simple. Well, the pensions went away. That knocked out that part of the stool. Social Security says that they're going to cut back that part, that cut another leg off the stool. This is not good. And what's happening right now is the retirement age has moved up to 65. We are having to plan and save another couple of years to make up for the fact that we don't have pensions anymore. Well, Charisse, I wanted to ask this. If somebody came in at 62 thinking that they're going to have to work to 65, are there times when you sit down and say, you know what? You've got the income. All we have to do is have some income planning here, and you can retire. You think you can't, but you can.
Pensions are certainly a dying breed. And in 1978, when they created that 401k, those pension managers and these companies did not want the liability of making sure you got income in the future. So they created this beautiful 401k, and you saved and it worked. And a lot of people have a lot of money in those buckets, but now you are your own pension manager, and life after the 401k totally changes, and people spend less money and they retire later because they don't know what to do. They don't want to run out of money. They don't know how to take income checks, and they retire later than 62, Randy, is because they get Social Security at 62. They know if they wait to retire to 65, they're going to get more. But when you don't have a secondary paycheck coming in to cover maybe some of your fixed bills and some other things, it is an absolute psychological and emotional hesitation that people have. And what I have learned that most advisors are not coaching is that if you have a income plan, a well-written income plan, most people don't have income plans like we have here. People will retire at 62. They won't wait till 65 because they also wait till 65 for insurance. And we let them know, hey, you don't have to wait because you have enough money for insurance and it doesn't erode your long-term investment plan, right? And so until people come in, we can build a pension, right? You're going to get Social Security. If you want that pension and you said, hey, Charisse, I got $1 million and I do want a pension. I don't want all of my money in a pension. Can you create that strategy for me? We can absolutely do that. I've never recommend all your money into that bucket because you're going to want liquidity and you're going to want to make sure a legacy is growing and you want long-term care coverage in case you need it in the future. So we want to be very diversified in our choices. But I will tell you, when you have a pension income, it gives you the okay to spend more money because it's always going to show up and it's never, ever going to go away. So it makes people feel comfortable that they can just keep spending. And those people who do have those pension checks coupled with Social Security, they still pull money out of their lump sum, but they don't pull as much because they don't need as much. Therefore, they're still spending more money than the average person who comes in with just a Social Security check and a 401k until they sit with us and we build that out for them. So I tell people, don't be afraid to come in and see what that's about. Don't be afraid of the conversation. Don't keep waiting because you're buying income. When you purchase a pension plan with us, and it takes a little time to grow. It could take 2 years, it could take 3 years, it could take 5 years, but it's growing at a guaranteed rate on your pension income side, which is really valuable to you. If you wait and come in 5 years, and then we start it, then you probably have to wait a couple more years to take it. So we want you to take it when you want to take it so that you feel that comfort level of spending that money earlier than later. So that's why it's just really important to plan ahead before you retire, that 5-year mark before retirement. But if you are retired, you can still build that in. You just might want to hold off a little bit so it can grow, in my opinion.
Well, 401ks have been a great savings vehicle for us, but they don't do anything for you when it comes to income. When you get to retirement, your 401k doesn't automatically pay you like a pension. That is up to you. That is where Charisse comes in, said, you've done a great job saving. Look at this nest egg. Let's build income out of it. What does it give you as a paycheck? And then combine that with Social Security. That's what retirement planning is. Give Charisse a call. Let's go through that process. Maybe you are heavy 401k, which is great. But what does it do for you in retirement? Let's figure it out. 833-368-3680. Again, 833-368-3680, or use the website, which is zinniawealth.com, ZINNIA wealth.com. Click on that gold box. Charisse, that is all the time that we have on this one. I will give you the last word.
Well, as usual, live by design and not by default. And we'll see you here next week.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.